Today, we're digging into something that might feel a little, well, let's say counterintuitive for a lot of investors. Think back maybe to the early 1600s. You've got Galileo, right, building on Copernicus's idea that the Earth orbits the sun and the powers that be. Not exactly thrilled. It shook things up, challenged what everyone knew to be true.
A classic paradigm shift.
Exactly. And you might feel a similar kind of jolt with what we're exploring today, because we're going to question something really fundamental in investing, something almost sacred, dividend-focused investing.
Right. The big question we're tackling is, could the best dividend strategy actually be to, well, avoid dividends entirely?
Yeah, this deep dive is all about exploring some fascinating research that really pushes back against that long-held belief.
Precisely. Our mission here is to unpack this surprising alternative strategy. We'll look at the theory behind it, the results they found both before and after taxes, and yeah, we absolutely need to talk about the potential downsides too. The goal really is just to help you get better informed about maximizing those after-tax returns, which is what matters at the end of the day.
Thank you for tuning in to Quantopian's Quant Radio, your AI-driven podcast exploring everything related to quantitative finance. If you enjoy this episode, don't forget to like and subscribe to stay updated on future releases. For more quant-focused content, join us at community.quantopian.com. There you can explore a wealth of resources, connect with fellow quants, engage in insightful discussions, and enhance your skills through our extensive range of online courses. Quant Radio is intended to help people develop their knowledge and skills in quant finance. This podcast is not intended to provide investment advice. And now, back to the episode.
So where do we even start questioning dividends? I mean, for so many people, they're the bedrock of a solid portfolio.
They really are.
You go online, search dividend stocks performance, and you're just flooded with articles, data showing historical outperformance.
Absolutely. There's tons of research.
And the data, like you look at figures going way back to 1928, it consistently shows high and mid-yield dividend stocks beating the broader market, like the S&P 500, usually by, 1 to 3% per year?
That's right. That outperformance is pretty well documented. It's kind of accepted wisdom.
But there's always a but, isn't there?
Well, yes. While that historical outperformance is there, the sort of real-world implementation question that often gets glossed over is taxes.
Ah, yes.
A
Taxes.
huge chunk of the total return from a dividend strategy comes from reinvesting those dividend payments. But here's the snag. Dividends have had, let's say, a very colorful history with tax treatment. Sometimes exempt, sure, but other times taxed incredibly high, like up to 90% way back when.
90%? Wow.
Yeah. Even now, at the current qualified rate, often around 15%, that's still a significant drag on your after-tax return. And that tax issue is really the core problem this alternative strategy tries to solve.
Okay, so if taxes are such a headache, why the intense love affair with dividends? Why are investors so almost religiously attached to them? It kind of reminds me of that old Pepsi challenge back in the 80s.
Interesting analogy.
Remember, in blind taste tests, people often picked Pepsi. Even Coke's own tests apparently showed it.
Right.
But who sold more? Coke, by a long shot. And researchers figured out it wasn't just taste. Knowing the brand, the memories, the advertising, that changed everything.
That's a great point. And why would investing be any different, really? Dividends have built up this incredibly powerful brand.
Yep.
You say dividends, and people picture, regular checks rolling in from solid, profitable companies.
Yeah.
Maybe while they're sitting on a beach somewhere.
The pina colada dream.
Exactly. It's a potent mental image, a really strong neural association between dividends and financial security. And that deep-seated bias makes it really hard to look objectively at other approaches, even if the numbers point elsewhere. It's a huge behavioral hurdle when you suggest maybe, just maybe, abandoning dividends could be better.
So let's tackle that head on. We have this behavioral bias, we have the tax drag. The research we're looking at asks this, frankly, audacious question. Can we build a better strategy by actively avoiding dividends?
That's the core idea. Can we replicate the good stuff, the total return, the historical outperformance, but without the actual dividend payments hitting your account?
And the theory being?
The theory is, by doing that, you sidestep those often painful tax treatments altogether, which should theoretically boost your after-tax returns quite a bit.
Makes sense on paper. Did they test that simple idea first?
They did. They ran an initial simulation, sort of a baseline. What if you just invested in the S&P 500, got its total return, but somehow received zero actual dividends, a 0% yield structure?
Okay.
And even that simple tweak, just avoiding the dividend payments, could boost after-tax returns by up to 1.2 percentage points per year.
Just from avoiding the checks.
Exactly, which is pretty significant. But they thought, we can probably do even better than just mimicking the index without dividends. That led them to the core theory.
Right. And this is where it gets really interesting, connecting dividends to something else. Value investing.
Precisely. There's this historical link. Dividend stocks, especially the high-yield ones, have often worked well, partly because they tend to trade at a lower valuation compared to the overall market. They have value characteristics.
So they overlap.
They often do. So the strategy pivots. Instead of chasing the dividend itself, it focuses directly on those underlying value factors, the things that made many dividend stocks attractive in the first place.
Trying to find a non-dividend dividend strategy, as the paper puts it.
Exactly. Capturing the performance drivers, but skipping the tax inefficiency of the actual dividend.
So how did they build this? What specific factors did they use?
They use what they called a value composite. Basically, they rank stocks based on a combination of 4 key metrics.
Okay, what are they?
Price to earnings, or PE, price to sales, PS, price to book, PB, and also enterprise value to EBITDA.
EV to EBITDA.
Right.
That gives you a broader look beyond just market cap, includes debt.
Exactly. It looks at the company's total value relative to its core operational earnings. Gives you a pretty comprehensive view of its valuation and efficiency.
So they combine these 4 ranks.
Right. To identify companies that scored really well on these value characteristics overall, the goal was to mirror the why behind historical dividend stock performance, just without needing the actual dividend payment.
Okay, makes sense. So let's get to the results. What did the simulations show before taxes? This is the 1974 to 2022 period, right?
Yes, and the pre-tax results are pretty stunning, frankly.
Lay them on us.
Okay. S&P 500, the benchmark, returned 10.87% per year. Pretty standard. The top 100 equally weighted dividend yield portfolio, so a classic dividend strategy, did quite a bit better at 13.97%. That fits the historical outperformance idea.
Okay, so dividends beat the market, as expected.
As expected. But then you look at the top 100 equally weighted value composite strategy, it delivered a massive 16.78% annual return.
Wow. Okay, that's a huge leap over both the market and the dividend strategy.
It really is. So the big takeaway here, even before you think about taxes, is that focusing directly on value seems to be much more powerful than just using dividend yield as a proxy for value.
It's like value is the engine and the dividend was just, I don't know, exhaust.
Maybe. But yeah, the value factor itself appears to be the primary driver. What's really compelling is they tested variations, like a value strategy that specifically excluded the top 25% highest dividend payers.
So actively avoiding high dividends, but still focusing on value.
Exactly. And even that strategy returned 16.31%, still comfortably beating the pure dividend yield strategy.
So value trumps dividends, even pre-tax.
The data strongly suggests that yes, focusing on value seems to be a much better value strategy than relying only on dividend yield.
Okay, so that's already compelling. But now, the real kicker. Taxes. You mentioned earlier, the tax man will not be denied.
Indeed. And taxes, as research from places like Vanguard also shows, can just take a massive bite out of your total returns over time.
So how did the picture change when they factored in historical tax rates?
Dramatically. They ran simulations using actual historical tax rates and even added hypothetical liquidation taxes at the end of the holding period. And the value approach just pulled further ahead. It consistently outperformed the other strategies after taxes, sometimes by a really significant margin.
Especially for higher earners, I imagine.
Exactly. For investors in higher tax brackets, the simulation showed that avoiding those high-yielding stocks and adding that value tilt was clearly the best approach.
So what happened to the pure dividend strategy after taxes?
This is maybe the most surprising part. The top 100 dividend yield strategy, and often the broad market S&P 500 strategy too, frequently ended up being the lowest performing strategies in pretty much every after-tax simulation.
Lowest. Wow. Can you give an example?
Sure. Let's take a high tax rate scenario combined with, say, a 35% tax on liquidation gains at the end. In that scenario, the value excluding top 25% dividend strategy still returned 14.65% after tax.
Pretty strong.
Very strong. But the pure top 100 dividend yield strategy, it dropped down to just 8.64%.
Oof. That is a huge difference, almost double the return for the value strategy.
The gap is massive.
Yeah.
And over long periods, that difference in compounding is just staggering in terms of wealth accumulation.
And you mentioned this isn't just for regular stocks. It applies elsewhere, too.
Right, they use REITs, real estate investment trusts, as another example. REITs are famous for high yields because they have to distribute most of their earnings.
Yeah, mandated payouts.
Exactly. And the paper shows the same principle applies. If you could capture the total return of REITs without the constant taxable income distributions, it would be a massive benefit for a taxable investor.
Okay, so the numbers look pretty compelling, especially after taxes. But nothing's perfect. What are the downsides or trade-offs here?
Good question. There are definitely important considerations. First, we have to come back to that behavioral challenge we talked about earlier.
The comfort of dividends.
Right. Overcoming that deeply ingrained dividends good feeling is a real psychological hurdle. Getting investors to actually adopt this, even with the data, is tough.
Sure. What else, performance-wise?
The other key thing is volatility. While the value strategies delivered higher returns in the simulations, they also tended to come with higher volatility. Looking back at the figures, the value composite had volatility around 20%, whereas the S&P 500 was closer to 15%, and the dividend yield strategy around 16.5%.
So more bumpy ride, potentially?
Potentially, yes. And alongside that, sometimes slightly larger maximum drawdowns. The value composite had a max drawdown of about negative 56.5%, a bit deeper than the S&P 500's negative 51%, or the dividend yields negative 55% in that period.
Okay, so higher returns, but also higher risk metrics like volatility and drawdown. That's a classic trade-off.
It is. And it's really important for you, the listener, to think about that in terms of your own risk tolerance and how long you plan to invest.
Absolutely. Now, this idea of prioritizing value and being skeptical of dividends, it might sound radical, but it's not entirely out there, is it? Some big names seem to agree.
Not at all. It's less fringe than you might think. I mean, look at Warren Buffett. Berkshire Hathaway has famously paid almost no dividends, just that one tiny one in 1967 he jokes about.
Why?
Because his entire focus is on creating value for shareholders. He believes capital is often better reinvested in the business, used for share buybacks, acquiring other great businesses, or paying down debt rather than being paid out as a dividend.
Because dividends are
Highly tax inefficient for the shareholder receiving them. That's his Achilles heel argument against them, essentially. If he can create more value internally, why trigger a tax event for shareholders?
Makes sense from his perspective. Any other examples?
Yeah, think about Will Thorndike's book, The Outsiders, which studied incredibly successful CEOs known for capital allocation. And Thorndike found these outlier CEOs generally disdain dividends. Why? Again, tax inefficiency. They were laser-focused on tax minimization as part of smart capital allocation.
Interesting. So it's a common theme among top capital allocators.
That seems to be.
Yeah.
And even, mainstream research from big firms like Vanguard basically supports the idea that focusing only on dividends is likely suboptimal if your goal is maximizing total return.
Okay. So wrapping this all up, what's the key takeaway for someone listening right now?
I think the central finding is pretty clear. Strategies focusing on value, especially those that actively avoided high dividend stocks, generated higher returns than traditional dividend strategies, even before taxes.
Right. That pre-tax win was significant itself.
It was. But then when you factor in the very real impact of taxes, the outperformance of that value-tilted lower dividend approach became even more pronounced, significantly more.
So it really brings us back to that initial thought, doesn't it? For you listening, maybe ask yourself, is your loyalty to dividend investing as a proven path to wealth?
Or is it perhaps more an allegiance to the brand of dividend investing, to that comfortable feeling of getting those regular payments, that image we talked about?
Because while that quarterly check, the bird in the hand, you might say, feels good.
This research strongly suggests that bird might be costing you, well, maybe 3 or 4 in the bush in terms of long-term after-tax wealth.
A really provocative thought to end on. It definitely encourages reflecting on the potential opportunity cost hiding behind those dividend checks. Thanks for unpacking that.
My pleasure. Lots to think about there.